All right. So without further ado, let's start with the session. First of all, a very warm welcome to all of you for today's session. The next webinar on the, or rather today's webinar, the part of our series Deep Dive with IIQ experts. Today's webinar topic, as you all know, is recent developments in world finance. These are like very important topics of discussion, not only for whatever has happened in the recent past, which are very significant events, and like again, this would be very significant in the history of finance as well. So to discuss about this topic, we are very fortunate to have with us Mr. Rajat Bhatia, who better than a person who has worked in the global finance industry in all major centers, New York, London, Hong Kong, Sydney, Mumbai, he has more than 30 years of experience working in leading positions with MNC Investment Banks globally, right? Uh, in terms of education, he has done his master's from Columbia University, New York. He has done his MBA from IIM Ahmedabad, has done his major in economics from St. Stephen's College, Delhi as well. He is an investment banker, a derivative trader, turned into entrepreneur, and is an academic as well. He's the founder and CEO of Neural Capital, a firm that specializes in developing quantitative trading strategies for the global financial markets. He's also a partner at Neural International Partners. So today, Mr. Bhatia, of course, he has always a lot of interesting nuggets to share about his experience, a vast experience rather, right? So he will be sharing his thoughts with us. And so yeah, with that, I will hand over the session to Mr. Bhatia. But before I hand over the session, just like a couple of quick things in terms of how we would go about in the webinar. Though most of you have the instructions, so you may have seen how we will proceed, but still maybe a little low down. So for the sake of good conduct of the webinar, since the participant list is generally quite large, so I mean, we would not be able to allow you to speak up, but nonetheless, there is a chat window, and as I have requested earlier also, please feel free to type in any questions, queries, or like any thoughts, or maybe any particular topics in the realm of today's discussion that you would like us to take up. We would be happy to take up those. We want the webinar to be as interactive as possible, right? And also, the breakup of the session will be first, Mr. Bhatia will be sharing his thoughts on today's topic for about 45 to 50 minutes. And then post that, we would be having the Q&A, right? Where we will try and take up every question that you all put up. Okay, we would be happy to discuss. And before we go into the Q&A, maybe for a brief 5 minutes, we will give a little intro about ourselves, Indian Institute of Quantitative Finance. So most of you are aware of the work that we do, but still maybe like we would elaborate for 5 minutes and then we'll take up the Q&A. Post the Q&A, if anybody has any specific question regarding the courses, we would be happy to take up course related questions as well. But that's post like the Q&A, right? So that like the other participants are not disturbed with the course related things. And for those who have joined the webinar, we have a very big surprise goodies for you, right? So in terms of if anybody gets interested in joining our courses. So with that, I'll hand over the session to Mr. Bhatia.
Okay, thanks, Nitesh. You have to give me the screen sharing rights.
Yes.
Can everybody see my screen, please?
Yes.
Okay, great. Okay, everybody, welcome to this webinar on recent developments in the world of finance. My name is Rajat Bhatia. I'm the founder of Neural Capital, and I've been associated with the Indian Institute of Quantitative Finance for more than 10 years now. I serve on the board of governors. I was also initially the dean of the School of Financial Engineering. The plan for today's webinar is to discuss some interesting developments in the world of finance these days. The first one is this, that the sun has finally set on Credit Suisse. Credit Suisse was a great bank, had a checkered history, but now it is part of UBS, and it's actually being made a part of UBS. So the bank doesn't exist, so to speak, just by itself. The other topic that we plan to discuss is the collapse of Silicon Valley Bank and some other banks in the United States. And third, which is very important, is what's next? Will the contagion spread, and what's likely to happen in the next year or two? That's a brief introduction about myself. I have been a veteran of the global financial markets, and I started a firm called Neural Capital, a boutique firm that specializes in quantitative finance. I started this firm in 2005 in Florida, and when I moved back to India in 2010, I started the firm over here in Delhi. And during my 36 years as a finance professional the world over, I have worked with several top-tier banks, hedge funds, energy trading companies, and strategy consulting firms. Now, I've worked with Citibank in India in the good old days in the late 1980s. I worked for Merrill Lynch Capital Markets as the country manager for India for debt capital markets. I also worked for Lehman Brothers in London in global derivative products, and for Citigroup Global Asset Management and Alternative Investments in London. I also worked in energy trading with Williams Companies based out of Tulsa in Oklahoma. And I was educated at Columbia University in the city of New York in 1991, 1992, where I pursued a master's degree in international banking and finance. Prior to that, I was at IIM Ahmedabad, 1985 to 87, and at St. Stephen's College in Delhi, 1982 to 85, where I majored in economics. Now, this is a photograph of the headquarters of Credit Suisse with the sun setting in the background. So the sun has set on Credit Suisse, rather unfortunate, but that's the reality that we have to face today. Now, Credit Suisse was founded in 1856. It was one of the world's leading banks. It was headquartered in Zurich, and it had a presence in all major financial centers around the world. Credit Suisse provided global investment banking, private banking, wealth management, asset management, and domestic retail banking in Switzerland. Credit Suisse was famous for strict bank client confidentiality and banking secrecy, which is also the hallmark of the Swiss banking system. The Financial Stability Board considered Credit Suisse to be a globally systemically important bank, also known as SIB. What it means is that the collapse of Credit Suisse could lead to the contagion spreading to the entire banking industry. And that is one of the reasons why Credit Suisse was forced into a merger with UBS, the Union Bank of Switzerland, so that the contagion doesn't spread to banks around the world. Now, Credit Suisse was also a primary dealer and FX counterparty of the US Federal Reserve System. So very, very important bank globally, a very well-known bank, very famous bank, but the sun has finally set on this great financial institution. Now, this is a photograph of the headquarters of Credit Suisse in 1895. Plenty of snow in Switzerland, but beautiful building. If any of you ever have a chance to visit Zurich, this is a building that you would certainly like to go and visit. Now, if you look at the storied history of Credit Suisse, we know that it was founded in 1856, and it funded the development of Switzerland's railway system. Switzerland has this really wonderful railway system. The trains run almost perfectly on time, and the funding for the Swiss railway system was provided by Credit Suisse. Credit Suisse issued loans that helped create Switzerland's electrical grid and the European rail system. In the 1900s, it began shifting to retail banking in response to the elevation of the middle class and competition from fellow Swiss banks like UBS and Julius Baer. Credit Suisse partnered with First Boston in 1978 And finally, it took over First Boston completely, and it started the firm called CS First Boston in 1988. CS First Boston was a leading firm in investment banking in the United States and also around the world. From 1990 to 2000, the company purchased institutions such as the Winterthur Group, Swiss Volksbank, Swiss American Securities, and Bank Leu. And some of the biggest institutional shareholders of Credit Suisse included the Saudi National Bank, which owned almost 10%, the Qatar Investment Authority, which owned 5%, BlackRock owned another 5%, and firms like Dodge and Cox, Knox Bank, and the Saudi Al Ayan Group were also significant shareholders in Credit Suisse. Shocking, but not surprisingly, the sun set on the Credit Suisse, one of the world's largest financial institutions with a checkered history of 166 years. But in March 2023, which is last month, it all came undone. On 15th of March 2023, Credit Suisse shares tanked significantly after Saudi backer rules out further assistance in the form of taking in more equity of Credit Suisse. Credit Suisse's biggest backer was Saudi National Bank. It said it won't provide further financial help for Credit Suisse. Now, at that time, Credit Suisse chairman Alex Lehman, he declined to comment on whether his firm would need any sort of government assistance in the future. However, the Swiss regulator said that Credit Suisse currently meets capital and liquidity requirements, and that the Swiss National Bank will provide additional liquidity if necessary, if there was a run on the bank. This is a very interesting graph. It shows the 5-year stock price movement of Credit Suisse and that of HDFC Bank. The blue line is Credit Suisse. The stock has fallen almost 95%. In the same period, the stock of HDFC Bank has grown by 70%. Now, what were the causes of the collapse of Credit Suisse? There have been a number of problems and scams within Credit Suisse over the last decade or so. The first one was in 2007 when they were mismarking the securities book in the United States. That led to significant fines on Credit Suisse by the regulators. In 2014 and 2023, there was a US tax fraud conspiracy. They had found some loopholes in the US tax system and the tax regulations, and they were exploiting them to avoid paying taxes. And there was a very famous scandal in Malaysia in 2015. It is known as the Malaysia Development Berhad scandal. Credit Suisse was also involved in that. That was in 2015. In 2017, the scandals moved to Mozambique in Africa, and there was the secret loan scandal in which, again, Credit Suisse was involved. In 2019, Credit Suisse was involved in a spying or espionage scandal. In 2018, they were involved in US Foreign Corrupt Practices Act violations. Then in 2021, there was this famous scandal in Britain called the Greensill Capital, a firm which went almost bankrupt. Even the Prime Minister of England, of UK, David Cameron, had a stake in this firm in Greensill Capital. And Credit Suisse was also, in the center of that. Then in 2021, there was a firm called Archegos Capital, which was a hedge fund. They blew up, and the other big banks like Goldman Sachs, Morgan Stanley, they got out on time, but Credit Suisse was left holding the can and lost a significant amount of money, running into billions of dollars because of the collapse of the hedge fund Archegos Capital. Unfortunately, Credit Suisse was also involved in foreign exchange manipulations, and it was convicted in that scandal. And in 2022, it was involved in drug money laundering in Bulgaria. And there were some others as well. So there's quite a long list. I mean, there are just 10 mentioned over here, but there were about 14 or 15 scandals that Credit Suisse was involved in. And that, of course, leads to the loss of trust. And as you all know very well, trust is the base or the foundation on which all banking is built. This is a very interesting graph which says Credit Suisse goes off piste. Piste is nothing but the slope of the Alps on which people go skiing, and if you go off piste, you basically end up with serious injuries. So this blue line is the stock price of Credit Suisse in Swiss francs, that has been collapsing, and now it's down to just 80 Swiss, 0.8 Swiss francs or 80 cents. Thiam, who was the CEO of Credit Suisse in 2020, he had to resign. There was because of the spying scandal. Then Credit Suisse announced that it had taken a big hit from the green silk scandal, which was in 2021. It also took a hit of $5.5 billion from the Archegos default, which was a big hedge fund, which went bankrupt. Credit Suisse, by the way, was one of the world's largest prime brokers and the prime brokerage business was a significantly large business running into multiple billions of dollars, providing a variety of services to the hedge fund industry. And as a result of that prime brokerage business, they had exposure to Archegos Capital. They had been lending money, providing margin loans to Archegos, and they lost $5.5 billion because of that. Then Axel Lehmann took over Credit Suisse as chairman after Antonio Horta Osorio was forced to resign. That was in January of 2022. Subsequently, Credit Suisse was found guilty in a cocaine cash money laundering case, which was based in Bulgaria. And then Ulrich Kohler, he actually took over as the CEO. So there were a lot of changes in the CEOs of the bank. So therefore, they could not have any steady leadership at the top because of the frequent change in leadership. And in 2022, they announced one of the largest losses in the bank's history since 2008. And just before Credit Suisse collapsed, the Silicon Valley Bank collapsed, and then a lifeline was secured from the Swiss Central Bank by Credit Suisse when the price was 186, but ultimately Credit Suisse was sold to UBS for just 80 cents. This was the forced merger between UBS and Credit Suisse. UBS was extremely reluctant to buy Credit Suisse, and it still says that there are plenty of risk involved in consummating this merger properly. So UBS agreed to pay Credit Suisse shareholders 3 billion Swiss francs in an all-share deal. The Swiss government also agreed to backstop 9 billion francs of potential losses from Credit Suisse's assets and allowed UBS to wipe out several billion dollars, $17 billion of Credit Suisse 81 additional Tier 1 capital bonds. Now let's talk about additional Tier 1 or 81 bonds of Credit Suisse, which have turned worthless. 81 bonds are debt securities issued by banks. They are a form of borrowing, but they have a special feature. They don't need to be paid back if a bank gets in trouble. A normal bond is above equity in the capital structure, but that is not the case of 81 bonds. These bonds had been very attractive to both European banks and investors. Regulators require banks to hold a certain amount of capital, which loosely defined is its assets minus its liabilities. 81s are a form of liability, but because of the special vanishing feature, they don't have to be counted in that formula. That actually makes the bank's capital bigger. For banks, issuing 81s is a cheaper way to increase capital rather than selling fresh equity. For investors on the other side, 81s carry higher interest payments than normal bonds, and that's the reason why investors were attracted to Credit Suisse 81 bonds. This is a very interesting graph which talks about a trip from par to pennies. In October of 2022, the Credit Suisse Group 81 perpetual 9.75% coupon bond was trading at par. But now that particular bond is worthless as of 21 March 2023. These 81 bonds are also known as contingent convertible bonds or COCOs. Now, this is one of the biggest loss in a $275 billion market. What is an 81 bond? These are asset class that was created after the 2008 global financial crisis to ensure that losses would be borne by investors and not by taxpayers in the case of a bailout of major banks. These bonds come with the risk that if a bank's equity capital falls below required levels, they can be converted into shares or wiped off. Why are the Credit Suisse AT1 investors crying foul? Usually, in the capital structure, shareholders or equity holders are the first to take a hit before any bond investor faces a loss. That's why the move to write down AT1 debt rather than shareholders has rattled Credit Suisse bondholders. Analysts have said that AT1s at most banks in Europe and the UK have more protections, but at UBS and Credit Suisse, these protections were not there. So $17 billion worth of wealth of AT1 bondholders has been completely wiped out, while shareholders of Credit Suisse have walked away with UBS shares. The agreement behind UBS's purchase of Credit Suisse includes the term of writing down $17 billion worth of additional Tier 1 or AT1 bonds that Credit Suisse sold to investors. Bondholders of AT1 bonds were meant to take the loss once shareholders' capital has been wiped out. In this case, AT1 bondholders have taken the loss before the shareholders of Credit Suisse took it. So this is an anomaly. Normally, it is the equity holders that take the loss first, but in this case, the bondholders have taken a complete hit initially. Now, UBS has bought Credit Suisse for $3.2 billion. So shareholders of Credit Suisse will get one share of UBS for every 22.5 shares of Credit Suisse that they held. So for shareholders of Credit Suisse, their entire wealth did not get wiped off from the bank's failure, but for AT1 bondholders, their entire wealth has been completely wiped out. So that was the collapse of Credit Suisse. If anybody has any questions, I'm more than happy to take them.
We'll take the questions together, I think, at the end.
Okay, that's fine. I'm perfectly happy to do that. So let's carry on to another major collapse that has taken place in recent times, and that's the collapse of Silicon Valley Bank. Silicon Valley Bank was a major bank in the Silicon Valley area. It had grown to become the 16th largest bank in the United States, and it is the second largest bank failure in American history. Now, this is the road to a bank run. Silicon Valley Bank and its customers thrived during the low interest rate era, but as the Fed started raising interest rates, Silicon Valley Bank found itself more exposed to risk than a typical bank. Even so, at the end of 2022, the bank's balance sheet was pretty robust and showed no cause for alarm, because most of the investments of Silicon Valley Bank were in US treasuries, which are considered very safe, but they're safe from a credit perspective, so there will be no default on them. But there is also market risk associated with US Treasury bonds, especially long-dated US Treasury bonds. Why this market risk exists? When interest rates are raised, the value of the bonds collapse, the value of the bonds begins to fall. In the case of long-dated bonds, like 30-year US Treasury bonds, the duration is very high. And because of the high duration, there is a considerable amount of market risk, which is there in the bonds, in US Treasury bonds held by Silicon Valley Bank. This kind of situation had happened once or twice even before. One specific example was 1994. In 1994, Alan Greenspan had started raising interest rates in the United States. He raised interest rates 5 times. At that time, I was based in Singapore, and I had a chance to go to Jakarta to meet some clients. And one of the clients I happened to meet was Lakshmi Mittal, who later on became one of the richest men in the world. And he was, very agitated. And he said that the private bankers had sold him US Treasury bonds, telling him that they were the safest investment in the world. And he said that he could not understand why he was losing money. Well, Lakshmi Mittal was losing money on a mark-to-market basis because as interest rates were raised, the value of these bonds fell, and these long-dated US Treasury bonds had long duration, so the values were collapsing quite rapidly. And I explained to Mr. Mittal how he could hedge his position using the futures markets, and that would prevent him from losing further value in his portfolio. And one of the statements that he made, which I still remember, he said that you are the only honest banker. He said, you are the first honest banker I have ever met. So that was a nice compliment to receive from a man who became the world's richest man later on. But the reality is that while US Treasury bonds don't carry any credit risk, they do carry market risk. The only instrument which is risk-free are these 3-month and 6-month US Treasury bills, because they are issued at a discounted price. They don't have any coupons attached to them. So you know that in 3 months or 6 months, you will get your $100 or your par value back. So there is no market risk or credit risk associated with them, but there is a reinvestment risk, because once you get your money, you have to reinvest it. Most Wall Street analysts were overwhelmingly positive on SVB stock, and Forbes magazine had added SVB to the financial all-stars list. On Wednesday, March 8, 2023, Silicon Valley Bank surprised investors with news that it needed to raise more than $2 billion in capital to shore up its balance sheet. And the reaction from prominent venture capitalists was not positive. Coat Management, Union Square Ventures, and Peter Thiel's Founders Fund moved to limit exposure to the 40-year-old bank. The influence of these firms is believed to have added fuel to the fire, and a bank run ensued. Now, SVB had a significant amount of its investments in SVB had the highest percentage of uninsured domestic deposits of all big banks. These totaled nearly $152 billion, or 97% of all deposits. And by the end of the day, that was March 8, 2023, customers had tried to withdraw $42 billion in deposits. The customers were trying to withdraw these deposits because these were large deposits, much greater in size than the $250,000 that is insured by the FDIC. And because the deposits were uninsured, they tried to move the money out of SVB into other banks. And that resulted in a run on SVB. As a result, in a mere 44 hours, the stock of SVB collapsed, but its roots lay in the end of low American interest rates. In 2021, US venture capital-backed companies had raised a record $330 billion, double the amount seen in 2020. At that time, interest rates were at rock bottom levels to help buoy the economy. Now, whenever interest rates are low everywhere, a dollar in 20 years is about as good as a dollar today. So a startup whose business model is, we will lose money for a decade building artificial intelligence and then rake in lots of money in the far future, it sounds pretty good. However, when interest rates are higher, a dollar today is better than a dollar tomorrow. So investors want cash flows. When interest rates were low for a long time and suddenly became high, all the money that was rushing to the Silicon Valley startups was suddenly cut off. As the money rushing into Silicon Valley startups was cut off, the deposits that were coming back into Silicon Valley Bank also evaporated. And this is exactly what happened with Silicon Valley Bank. The 84% drop from the hallucination peak of $700 exceeded Silicon Valley's bank dot-com bust plunge of 77% from September 2000 to October 2002. So for the 2 years from September 2000 onwards, the price of Silicon Valley's bank had collapsed by 77%, but the drop in recent times was 84%. So once this massive drop happened, it was only a matter of time before Silicon Valley had to be taken over by the FDIC. There's this concept of mass extinction of startups. Mass extinction of startups means that as money rushing into startups dries up, many of the startups suddenly start dying because they're still not making revenues and they're relying on investments by venture capitalists to keep them alive. So this mass extinction of startups eroded SVB's deposits. The collapse of the IPO and SPAC bubbles closed the exit doors for venture capitalists. and they stopped funding many of Silicon Valley startups. Suddenly, the Silicon Valley startups had to survive with whatever VC investment they had received because new investment was not coming. Since the startups were burning cash rapidly and could not cut costs fast enough, a mass extinction event happened, and the vast majority of startups ran out of money, and so did the deposits at SVB. And this is exactly what happened. As interest rates in US Treasury bonds started to go up, Silicon Valley Bank started to lose money dramatically. As SVB grew to be the 16th largest bank in America, it invested its funds in long-term bonds when interest rates were low. But as I mentioned earlier, these long-term bonds have long duration, and when interest rates start rising, they suffer from huge market risk. So when interest rates rose, the prices of the long-term US Treasury bonds and mortgage-backed securities held by SVB fell rapidly. On 13th March 2023, which also happened to be a Wednesday, SVB announced that it suffered a $1.8 billion after-tax loss and urgently needed to raise more capital to address depositor concerns. Now, banks only carry a small proportion of depositors' money in cash. This is something called fractional reserve banking. This is the bedrock of how banking is carried on the world over. This meant that SVB could not give depositors the money because it was held in long-term bond investments that were no longer worth as much. And as SVB did not have the money to pay the depositors, a panicked withdrawal continued and a bank run was underway. And SVB had $209 billion in assets and $175 billion in deposits at the time of failure, according to the FDIC. Many of SVB's depositors were technology workers and venture capital-backed companies in the Silicon Valley. The Federal Deposit Insurance Corporation took over SVB on Friday to get depositors access to the money by Monday because the bank's troubles pose a systemic risk to the financial system. This term systemic risk is very important and is something that you should keep in mind. Systemic risk refers to the risk of a contagion or the risk of one bank's collapse causing other banks to fail as well. That's systemic risk. Please do not confuse it with systematic risk, which is the risk which cannot be diversified away by holding a larger and larger portfolio of stocks. So there's an important difference between systematic risk and systemic risk. Systemic risk is the risk that a contagion or a collapse in one bank could spread to another. And this is the timeline of collapse. It started on February 27th, and by 14th of March 2023, SVB was history. Now, the important question is, well, what's going to happen in the future? Nobody can predict the future with great accuracy, but we can always make informed and intelligent prognosis of what's likely to happen. What's going to happen next? Will the contagion spread? Now, this is a very, very interesting graph. This is a list of top American banks by uninsured deposits. Silicon Valley Bank was right there at the top. BNY Mellon is also has very high number of uninsured deposits, 92%. Why do these banks have uninsured deposits? Because they have very large deposits, often held by foreigners. According to some statistics, about $18 trillion of deposits are there in American banks, of which $8 trillion are held by foreigners. And if these foreigners smell the possibility of the bank going bankrupt, they will start to withdraw the deposits and take them to another bank for safety. So BNY Mellon, State Street Bank, Signature Bank, which is another bank that has collapsed, it had 89.3% of its deposits were uninsured. Northern Trust Bank, Citibank, CIBC, HSBC, Continental Bank, many of these banks have much more than 50% of the deposits as uninsured deposits. And these uninsured deposits can behave like what is known as hot money. So today they're there with your bank, tomorrow they could be gone because the depositors want to withdraw their money and take it to another bank for the purpose of safety. Now, 186 banks have been found to have similar vulnerabilities as Silicon Valley Bank. This is a study done by scholars and academics in the United States, and they have found that 186 banks would end up with a similar fate as Silicon Valley Bank. So the fire in the city is not yet over. It is spreading from one building to another, and 186 other banks are at risk. In fact, I have seen a study done by some very serious people who have been involved in the banking and financial markets industry for several decades, including stints at firms like BlackRock. They are saying that only 6 banks will be left in the United States in the next couple of years. By 2025, that is likely to happen. Will that happen or not? We don't know for sure, but there is definitely a significant amount of risk in the US banking system as we speak. And the collapse of Silicon Valley Bank, it highlights a $620 billion hole which is lurking in banks' balance sheets. What are these holes? Many US banks are sitting on unrealized losses. As higher yields push bond and mortgage-backed securities prices lower, the banks are sitting on larger and larger unrealized losses. These are mark-to-market losses. Losses have not been taken, but they are there. So here we are, the Social Science Research Network. They did a study which was titled Monetary Tightening and US Banking Fragility in 2023, Mark-to-Market Losses and Uninsured Depositor Runs. It says that 186 American banks could fail if even half of their uninsured depositors withdraw the funds. And more than 300 billion of insured deposits are also at risk as a result of that. This is a very interesting graph which shows US bank failures in this century, in the 21st century to date. So the red ones that you see are, the pink ones are the ones which took place between 2001 and 2006. That was prior to the global financial crisis of 2007, 2008. And the red ones are the collapses that took place after the global financial crisis of 2007, 2008. So between 2007 and 2008, the banks which collapsed are given by the red square. And from 2011 to 2023, the collapses that have taken place are in the blue squares. Now, I had published a paper in the Hedge Fund Journal, which is published out of London, in September 2007, predicting the global financial crisis of 2007-2008. This paper is called Financial Chernobyl or Manageable Risk, the Brewing Storm in Subprime and CDO Markets. If you do a Google search on Financial Chernobyl, the Brewing Storm in Subprime Market, you will come across this paper on the website of the Hedge Fund Journal. It's a pretty long technical paper, but the main thing is that it predicted the global financial crisis 2 months before it happened. And if you're interested, you're welcome to read it. Now, another interesting study which uses deep learning and artificial intelligence has predicted about 27 US bank failures inside the European Union. Now, this kind of prediction can be done using neural networks and deep learning techniques. It's another interesting paper that you can take a look at. And this is published by the University of Budapest. So that, my friends, is the end of the webinar or the presentation from my side. Thank you very much for joining in. I hope you enjoyed it. And I'll be very happy to take any questions that you may have. Nitish? Hello.
Thank you so much, Mr. Bhatia. It was really an insightful session as always. There are a lot of questions, and we will be taking up the questions one by one. But before we take up the questions, I would take up like 5 minutes to just speak about the work that we have been doing at Indian Institute of Quantitative Finance. So you may also take a little breather, and then we will go into the Q&A. I hope my screen is visible. Is my screen visible? Can somebody confirm?
I can see it, Nitish.
All right, thank you. Right, so as you all know, I represent Indian Institute of Quantitative Finance, and just a minute. Okay, right. So there's some disturbance. Just allow me one moment. Right, so we are a body which is the oldest and the leading and still the only specialized body in education and training in the field of quant, that is quantitative finance and financial engineering. So we conduct education and training in the fields of quantitative finance, financial engineering, risk management, quantitative algorithmic trading, and now going into AI and ML, of course. Right, so we were founded by pioneers in India and top experts from the field of financial risk management, financial engineering, and investment banking. We are an educational institution focusing on promoting education and training in the field of financial engineering and all these areas that we talked about: quantitative finance, risk management, investment banking, algorithmic trading, derivative products, pricing and valuation, AI and ML, and several other areas of modern finance. And we have been conducting our courses for more than a decade now. So the current courses that we have, the prime courses, we have recently introduced a course certificate program in machine learning for finance, which is like a specialized course in machine learning where we teach machine learning and its application in areas fintech, algorithmic evaluation, pricing, and risk management. So it's a 7 months weekend course. Then we have our courses of in quantitative finance and risk management, the certificate program in quantitative finance and risk management, which is like a very deep 6 months, again, weekend course where we comprehensively deep dive into both theory and practical modeling for derivative valuation and pricing and risk management. And then we have a course on financial engineering, certificate program in financial engineering, another 7 months weekend course, which is like a more deeper mathematical modeling course, a comprehensive course which covers both the deep theory plus practical mathematical modeling for derivative valuation and risk management. And then we have a couple of courses in algorithmic trading, those who are interested in quantitative trading and other algorithmic trading with the quant and non-quant strategies, right? So we have a course called postgraduate program in algorithmic trading, which is a 6 months course, teaches all aspects of algorithmic trading using technical analysis, machine learning, and quantitative models. And then we have a shorter duration certificate program in algorithmic trading, which teaches algorithmic trading using technical analysis based models. So these are all courses which one can utilize to make a foray or like again build your career in the field of quant or risk or derivative trading, quantitative trading, risk management, and I mean, of course, now in machine learning and artificial intelligence in finance as well. So, I mean, depending on your interest, inclination, on what area in finance you want to specialize, one can choose any of these courses. Over the period of like more than a decade of our existence, we have been fortunate to have a lot of students who themselves are like professionals. Some of them are, of course, like freshers as well, but most of them are like working professionals. And they have utilized our courses to improve their career uh, quite a bit. A lot of them have made a foray into this advanced analytical fields in finance after doing these courses. So a lot of them have shared their thoughts, just like a few, to give an example. Abhijit is them. Then we have Rohan, one of our certificate program financial engineering student. Again, Karthik, CPF student. Yatish did our algorithm. So they have all been kind enough to share their experiences. You can also go to our website and look at like the other testimonials and all. Testimonials are not to advertise our courses, but for you to understand, in case somebody is exploring this field, right? For you to understand how you can utilize our courses to improve your career, or like again maybe to enter into the field of quant and risk and all these areas of advanced analytical finance, right? So our courses, from our courses, the kind of companies where you can target are like maybe hedge funds like Renaissance Technologies, DSO, Citadel, Millennium Partners, to name a few. Investment banks like Goldman Sachs, Morgan Stanley, Deutsche Bank, and so on and so forth. Of course, the commercial banks as well, JP Morgan, Citibank, Nomura, and not to forget the Indian banks as well. The stock exchanges, of course, the NSE and NYSE and all other exchanges, the consulting firms nowadays, they recruit very heavily in the quant and the risk consulting domain, right? So companies like EY, Deloitte, PwC, and all, they have been recruiting heavily in the last few years. And of course, even the IT companies like Accenture, Cognizant, TCS, and all of them, right? So they do support the international banking and financial institutions. So they also recruit quite heavily. So by doing our courses, you can target the profiles in the quant and the risk management industry in companies like this. And the types of jobs that you can target, of course, the different courses can target like different kinds of job within the quant industry. But to summarize, you can be a quantitative research. I can be into quantitative research and analysis. You can be developing quantitative and analytical software. You can be in the model building teams, building valuation models, model validation teams, portfolio management, portfolio analytics, in risk management. You can be in market risk, credit risk, operational risk, liquidity risk. You can be in the derivative structuring teams, quantitative trading teams, high frequency trading teams, in other algorithmic trading and derivative trading teams, right? So all of this can be targeted. And yeah, I mean, it has been a long journey. We have been fortunate to work with most of the leading financial institutions, international as well as domestic. To name a few: JP Morgan, BNY Mellon, Thomson Reuters, ING, Capgemini, I mean the BSC, NSC, the Bombay Stock Exchange, National Stock Exchange. We have even done trainings to prepare the risk management teams of LIC when they were formed, right? So analytical companies like Globo and other banks like Society Generally, Citibank, and all. So these are like just a list of just a few organizations. The list is huge. The journey has been very long. And then, of course, we have tried our part in propagating our field and like conducting workshops, seminars in the premier educational institutions as well, IIT Bombay, BITS Pilani, NITI, and all. Recently, in the last month, we did a workshop in IIT Bombay again. So our endeavor has been to promote the field of quant finance in India, and in that endeavor, we have been tirelessly working for the last decade and preparing many candidates and many students to make a wonderful career transition into this field. Right. And yes, so the goodie that I was talking about, so to appreciate your time, and since you have spent on a weekend that you have come and attended our webinar, in case somebody gets interested in joining any of our courses, in all these courses, you have a 30% waiver on the course fee as a special waiver for people who are attending the webinar, right? You can, I mean, whichever course you are joining, the certificate program in machine learning for finance, or certificate program in financial engineering, certificate program in quantitative finance and risk management, postgraduate program in algorithmic trading. You can use this code webinar 0803 to join any of these courses before 12th April to avail the special waiver. Right? To avail this waiver, I will be sharing the contact details of our team. Just a minute. So you can touch base with us. You can visit our website, and you can contact us. You can call us in this number. This will all be, of course, provided later on as well. You can go to the website and connect, or you can email us, and we will guide you regarding the registration. You can use this code webinar 0803 to register with to any of these courses with a 30% waiver. Of any of the, I mean, there is no, I mean, normally the early bird waivers that we give sometimes are like time dependent, but these are like a special waiver for the people who are attending this webinar, right? So with that, I will go to the Q&A session. Of course, for the questions, I mean, further questions regarding the course, we would take them up. But after like discussing the Q&A, if anyone has any discussion, want to discuss anything related to the course, we will take up those questions as well. They can put up in the chat window. But in the meantime, let's go to the Q&A. There are a lot of questions that has been asked. So we'll be taking up the questions one by one. So Mr. Bhatia, I'll be reading out the questions, and
Okay.
then you can answer them.
Okay, sure.
So the first question was from Mrityunjay, and he wants to ask whether de-dollarization, so I means like again, he's talking about dollar and replacing the dollar, happens in a decade's time. Will RMB take place as a reserve currency? So would you like to share your thoughts on that question?
Sure. That's a very good question. In fact, we may do a webinar in the future on de-dollarization of the global economy and what impact it's going to have on the world.
Right.
When people move away from the US dollar as the reserve currency, most likely the new reserve currency is going to be the BRICS, with Russia, India, and China playing an important role in creating a gold-backed currency called the BRICS. So it's not necessarily going to be the yuan itself, but most likely it's going to be the BRICS currency, which will be the reserve currency of the future.
Right.
Just to give you a bit of a history, in 1970-71, that is when the United States went off the gold standard. It was Richard Nixon was the president of America at that time. Most people don't realize this, but it was actually a form of default by the United States. American imports were very high compared to their exports. They were running a massive trade deficit. And because of the trade deficit, they had to go off the gold standard because they simply could not pay foreigners who held dollars in 42 ounces of gold for every dollar that was held. It was just not possible. So that was actually effectively a default. Most people don't talk about that as being a default, but it was a default. And ever since America went off the gold standard, what has happened is that the United States government has been printing dollars in large quantities. And ever since the 2007-2008 financial crisis, the way out of that crisis has been to create a bigger bubble. In fact, that is something I write about in my paper, Financial Chernobyl or Manageable Risk. So to answer, the simple answer to your question is, it will be the yuan as the new reserve currency? My view is that most likely it will be the BRICS. as the new reserve currency. It will be backed by gold or by commodities. It can be even backed by some commodities which are in scarce supply. So that's the future of the world, and we are seeing decline in the United States, both as a superpower as well as the country issuing the reserve currency for the world, and the rise of Asian countries. There's China, India, and Russia as well, since a large part of Russia is actually in Asia.
Right, right. So going into the next question. So first thing is, Mr. Jay, I hope that answers your question. Thanks so much, Mr. Bhatia. So going to the next question, Sabapati has asked, let me see, the question is not very clear probably. Is the raising interest rates will bring markets, or it is due to over valuation crash? I'm not sure about the question. Did you get the question, Mr. Bhatia, or shall I
Yes,
ask
no,
Sabapati to?
that's okay. We are fine. See, there is,
Okay.
as interest rates rise, these asset bubbles begin to crash. You will see a collapse in the stock market to an extent, but you will certainly see a fall in the value of bonds, because the prices or the value of bonds is inversely proportional to the interest rates in the marketplace.
Right.
So as interest rates are raised by the Federal Reserve, you will see a lot of problems in the bond market, fall in the value of the bond prices. You will also see corrections in the stock market. You're already seeing problems in the startup world with lesser and lesser venture capitalists and unicorns who have the cash available or the money available to fund new startups. So yes, rising interest rates will have a negative impact because the world of free money is going away.
Absolutely. Absolutely. So hope that answers your question. Going to the next question, Ornob has asked, sir, it would really be helpful if you can give us an idea regarding financial maths and how is it different from normal mathematics? So though it's a question a little not really tied to today's topic, but again, in case you want to take that up.
I'll be quite happy to take it up. Well, financial maths is nothing but the application of mathematics to the financial markets. See, if you go back in history, you look at accounting. Accounting was simply the application of arithmetic, plus, minus, multiplication, division to finance. And as the financial markets have evolved, the practitioners have started to apply various techniques from statistics and mathematics to better understand and analyze the markets. One of these techniques that was applied to the financial markets, especially the equity markets, was the use of moving averages to smoothen out the noise and make some predictions about where the market is going. Now, that is an application of still fairly basic mathematics to the world of finance. Then when we came to the bond markets, basically techniques like compounding, discounting, these are all mathematical techniques which involve the use of higher powers in equations, basically the use of polynomials to understand the workings of the bond market. Now, in 1974, some professors, Myron Scholes, Fisher Black, they got the Nobel Prize for economics for doing this work. They applied stochastic calculus to the valuation of options. So this was the application of fairly advanced mathematics. Calculus is something that you study in your last year of high school or in engineering school, engineering institutions. So the application of stochastic calculus to financial markets came into being in the mid-1970s with the development of the Black-Scholes model. And then the development of the binomial option pricing model also uses a lot of mathematics to the financial markets. And in more recent times, with the advances in computer science and computing power, you will find that there's a lot of opportunities in the world of finance that are being exploited by the application of more advanced mathematics and computational science or computer science to the financial markets.
Yes, absolutely. So I hope that answers your question, Abhishek. I mean, any follow-up questions on that? If you have, you can put it up. We'll take it. But before that, let's go to the next question. It's from Anchal. And Anchal has asked a very specific question. He has said that, sir, what is your opinion on the future outlook of bulge bracket organizations, specifically Citibank, amidst the failure of SVB and Credit Suisse? Any thoughts on that?
See, many of the bulge bracket firms are under immense pressure. I have worked with Citibank twice. Once in India, I was an interbank foreign exchange trader at Citibank in Bombay and Nariman Point. And the second time, I worked with Citibank in London in global asset management, in alternative investment strategies. So the Citibank that I knew in India is very different from the Citibank I knew in London. And it is very different from the Citibank as I know it today. Because of a lot of regulations, the Citibank is no longer the very fast-moving, technologically advanced entrepreneurial bank that it used to be. And being a systematically important bank or an SIB, it is under a lot of regulatory scrutiny. Now, will Citibank go under? It's difficult to say that, but given that Credit Suisse went under, it's reasonable to say that there is no bank which is without risk of collapsing. In fact, there's a lot of talk of Deutsche Bank being the next in line to become a Credit Suisse, but that is something that only time will tell. But specifically about Citibank and other bulge bracket banks, they will remain under pressure. They will remain under a lot of regulatory scrutiny. And as I mentioned, there is a recent study by some very serious analysts of the financial markets who are predicting that by the year 2025, only 6 banks will remain in the United States. But these banks will include JP Morgan, Citibank, Wells Fargo, Goldman Sachs, just the top bulge bracket banks, only they will survive. Now, that's an individual viewpoint based upon, of course, rigorous analysis, but that is a possibility. My personal view is that the bulge bracket banks will remain under a lot of pressure, but they will still be there, because if they collapse, or if all of them collapse, then there will be a big problem in the world of global finance.
Correct, absolutely. So now going to the next question from Praveen. He asks, can we say that major reason is the loss of trust? Acha. There's a small PS note anyway. Can we say that major reason is the loss of trust of depositors due to CS's involvement in many fraudulent cases?
Yes, whenever a bank is involved in scams, that is surely going to make depositors very worried. But as the stock price of Credit Suisse came under pressure and began to fall rapidly, the depositors were worried that their money was no longer safe. Now, Credit Suisse had about $1 trillion in customer deposits, out of which about 480 billion, almost half of it, were withdrawn by depositors who were worried about the safety of the money. And as that money is withdrawn, Credit Suisse had less and less money left in its asset management and wealth management business, which was actually a very profitable business. But if the deposits are not there or they get withdrawn, then their top line gets eroded. And as top line gets eroded, the bottom line gets eroded as well.
Right. Absolutely. Okay, so next question is from Zafar, and he asks, why would startups be more attracted to SVB for their deposits instead of any other avenues? Were they providing better rates than others?
Well, Silicon Valley Bank being a name synonymous with Silicon Valley, a lot of startups and venture capitalists ended up putting the money in Silicon Valley Bank. And that is why it grew to become the 16th largest bank in the United States. But there is otherwise no reason. I mean, the depositors could have taken their money to Bank of America, which is also a Californian bank, and put their money there. So either Silicon Valley Bank was providing better facilities or better services to the startup community. One area where Silicon Valley Bank was certainly doing much better in terms of providing services to the startup community was in what is known as an ARR loan. ARR stands for annual run rate. So not ARR, so annual run rate. That's what ARR stands for. So what Silicon Valley Bank would do is that it would first provide a startup with 20% of its annual run rate or annual revenue as a loan. And if that loan was repaid on time and everything was fine, then they would increase the 20% to 30%, then to 40%. So Silicon Valley Bank was actually funding the growth of startups without taking an equity stake in the startups themselves. So this was a very attractive form of capital for startups looking for money to grow their businesses without having to dilute their equity, because they were just taking a loan. They were not, providing any equity stake in their businesses. So this had been a very popular facility that Silicon Valley Bank provided to the startup community in California. And perhaps that is one reason why a lot of startups continue to keep their money with Silicon Valley Bank. Also, on the face of it, Silicon Valley Bank looked like a very safe bank, especially when interest rates were low. It's only when interest rates started rising and the Silicon Valley Bank was facing mark-to-market losses on its holdings of US Treasury bonds and also its holdings of mortgage-backed securities that the panic spread, and that led to the collapse of the bank.
Right. So next question is from Abhijit, and Abhijit has asked, from risk perspective, what are the warning that has been missed by both SVB and Credit Suisse? Any thoughts on that?
See, in the case of Silicon Valley Bank, the most important risk factor that was missed was market risk. As interest rates rose, the value of the bond holdings began to fall. So there was a huge market risk involved, and that is what caused the collapse of Silicon Valley Bank. That was probably missed by investors, but eventually the investors caught up, and that's what led to the collapse of the bank. In the case of Credit Suisse, it was a lot more complicated. There were, scam after scam after scam. I mean, like you saw just 10 scams that I listed. There are probably quite a few more. And when scams begin to hit a particular bank, it shows a lack of controls, a lack of ability to comply with regulations. Where a bank like Credit Suisse is unable to even control the laundering of money from the drug business in Bulgaria, that's a very serious matter. And when the financial world takes cognizance of these scams, it becomes pretty obvious that the bank is not being managed properly. One of the areas where a very important risk factor was missed by Credit Suisse was in the case of Archegos Capital. Archegos Capital had been borrowing heavily against their holding of equity securities in the financial markets. Other banks like Goldman Sachs were able to move very quickly and actually sell those securities when Archegos Capital was not able to meet margin calls. But Credit Suisse was slow in responding to that problem. and that is why it was left holding the can and suffered a loss of $5.5 billion during the collapse of Archegos Capital. Now, $5.5 billion hit on a bank's bottom line is a very big hit, even by the standards of globally systemically important banks. So in the case of Credit Suisse, it was a lot more complicated. There were many risk factors that were missed. There were compliance issues, there were regulatory issues. There was inability on their part to respond to the collapse of Archegos Capital. And all those things put together hurt their bottom line, hurt their reputation. And once bottom line and reputation get hit, then trust becomes a very major factor. And once trust is gone, then the bank is gone as well.
Yes, absolutely. Very well summarized. Right. So going to the next question again from Abhijit. So he asks, what is the impact of US exporting inflation to other countries by printing dollar? What are the implications for Indian banks? Any thoughts on that?
Yes, sure. Well, if you look at history of the last just 10 or 20 years, one thing you will notice that in small towns in India, places like Goa, Ajmer, Jaipur, Dehradun, second tier and third tier towns, properties were exchanged, were valued at just in the lakhs of rupees, maybe 40 lakhs, 50 lakhs. Today, even in those places, properties are now valued in the crores of rupees, 1 crore, 2 crores, 3 crores. So one of the impacts in India has been the creation of an asset price bubble. There has been an asset price bubble in the stock market. There has also been an asset price bubble in the real estate market. And one of the principal causes, the root causes of this creation of asset price bubbles has been the printing of money in the developed economies, not just in the United States, but also in Europe and also in Japan. Japan in particular suffered from this severe problem. There was a time when the real estate prices in Japan had gone to the stratosphere. If a bank sent you to work in Tokyo, they would have to give you an extra $10,000 or $7,000 a month house rent allowance, because without that you would not be able to rent any property to live in. So there have been asset price bubbles created the world over as a result of the printing of a lot of money in the United States. And in Japan in particular, we have seen the last 30 years to be a period of stagflation, which means that you have inflation and you have very high and still no growth. So Japan has been suffering from that problem. Europe is suffering from that problem right now, and now that problem has come to the United States. We are going to see a period where there's going to be inflation. And another reason for the inflation that we are seeing is actually the war in Ukraine that has caused food price inflation, because Ukraine was a supplier of wheat and sunflower seeds and other, food grains to the rest of the world. And then the sanctions on Russia, which was a major supplier of energy, whether it was natural gas or oil to the rest of the world, those have caused, retail inflation. So yes, printing of money in the United States has been a principal cause of the export of inflation, even to India. And now as the United States Federal Reserve starts raising interest rates, we are seeing the adverse impact of more expensive money in the form of problems like the collapse of SVB.
Wonderful. So I hope, Abhijit, that answers your question. So going to the next question, or before going to the question, Satya Prakash has a question, but Satya Prakash has also shared his feedback. Thank you, Mr. Bhatia, for the presentation. It was an eye-opener. Thanks, Satya Prakash, for your kind words. Now, going to his question, he has asked, I have one question. After so much talk on ESG, particularly on G part in EU and financial market. Why these kinds of things happening, and will there be accountability fixed? And the second question on, can we do better in future of predicting such events in future, and more importantly, preventing it?
See, I will be the first person to admit that I'm not an expert on ESG, so I will not try to, uh, express my thoughts on that, since I just don't know enough. But your second part of the question, that will they be able to manage things better in the future? Well, I certainly hope so, because the adverse impact of developments in the United States financial markets and the European financial markets is felt the world over. The collapse of the SVB bank has its impact on India as well, especially on the startup ecosystem in India. A lot of Indian, startups have been working very hard. They have some wonderful products, some wonderful technologies, but they just don't have enough risk capital to enable these startups to, come to fruition. Now, with the collapse of SVB, the negative impact is not just going to be felt in Silicon Valley. Its impact is also going to be felt on startups in India. So the impact, spreads all across the world. So, I hope that in the future that this monetary policy is better managed, so that we don't have these kind of booms and busts. But booms and busts are a fundamental part of the capitalist economy.
Yes, absolutely. Next question is from Praveen, and Praveen has asked, Fed is constantly increasing rates. Is Fed stuck between containing inflation and value of dollar and banking systems liquidity? What's your view?
Yes, the Fed is stuck between a rock and a hard place, or as they say, the devil in the deep sea. If they raise interest rates, you see the problems that we are facing: collapse of SVB and Signature Bank, and First Republic Bank, and another 186 banks are at risk due to rapidly rising interest rates. One of the experts in the marketplace has been predicting that around June this year, the Fed will have to call an emergency meeting and just lower interest rates. So we'll wait and see if that happens. The middle of the year, June is not very far away. We are already in April. So this, bitter medicine of raising interest rates, while it is necessary to contain inflation, it can also have an adverse impact. Just like, if you start taking too many antibiotics, your body can have an adverse reaction to that. But at the same time, antibiotics are necessary if you are suffering from a severe medical problem which requires their prescription.
Yes, very well summarized. Our next question is from Achal. She is saying that I am planning to switch to Citi. Your advice? Probably she's a little afraid hearing about the talks about the bank collapse and all. So any advice to her?
See, I don't think Citi will collapse, or it will be allowed to collapse. It won't be allowed to collapse. Even during the times of 2007, 2008, Citibank was bailed out by the US government when Vikram Pandit was the CEO. So I don't think Citi will collapse. The problem that you may face is there could be layoffs. But again, it depends on which part of Citi you're joining. If you're joining Citibank India, I think you shouldn't have to worry, because from what I understand from some of my friends who work in Citibank India, the bank is doing very well. So why would the bank cut back on people in a part of their institution where things are going very well? Most of the problems are going to be felt in the United States and in Europe, not so much in India. But if you are planning to join their, what are they called, the centers of excellence, or these KPOs, which are there in various parts of the country, there could be cutbacks over there, because these KPOs don't cater to the Indian business of Citibank. They cater to the foreign businesses of Citibank. So in a KPO, you could be doing work for, doing a presentation or a spreadsheet or writing a software program for Citibank in London or Citibank in New York or Citibank in various parts of Europe. So those could be impacted. But Citibank India, the business itself, as far as I understand it, is doing extremely well. And I also understand from a friend of mine who is a very senior risk manager at Citibank in India, that the RBI is very pleased with Citibank's approach to risk management and all the things that they have put in place to prevent any kind of problem.
Right. So that's like very well summarized again. Thanks for sharing that thought. So next question is from Soham. Soham says that Credit Suisse has over 500 to 600 billion in assets under management. So now what would happen to those assets? And it's very shocking, and it's almost seems that Credit Suisse was driven to failure by force after Credit Suisse survived 1929, 1987, 2008. Any thoughts on that?
Well, the assets of Credit Suisse are now going to become the assets of UBS. So,
Right.
Now it's UBS which has taken over the bank. According to the CEO of UBS, this forced merger is a pretty complicated exercise. It's going to take a fair amount of time to make this merger work properly and to, go through all the processes that are required in any merger situation. But now the risk that those assets are now part of UBS. So will UBS be the next Credit Suisse? We don't know. But if UBS is severely impacted, it would have a major adverse impact on the Swiss economy because it's heavily dependent upon banking.
Yes, absolutely. So going to the next question from Praveen, he asked, will there be recessions ahead for Europe and US in coming 2-3 years? So we have been hearing a lot of talk of recessions and predictions. So please share your thoughts on that.
Yes, well, there are already problems in terms of financial problems and economic problems in Europe and the US, more so in Europe. The war in Ukraine has had a very severe impact on countries like Germany. Germany was the world's powerhouse when it came to industrial technology and industrial manufacturing. And that relied upon cheap natural gas from Russia. Now, that doesn't exist anymore, especially when the Nord Stream 2 pipeline was blown up or sabotaged, to be more specific. So Germany is already facing problems, is already facing severe problems, in fact. In fact, I understand that in the headquarters of Deutsche Bank, you cannot get hot water anymore to save on energy costs. And people are having to pay a lot more in energy bills for heating, again, for air conditioning, for gasoline and other things. Industrial companies have to bear higher energy costs. All that is going to have a negative impact. While the president of France was recently visiting China, there were riots going on in Paris. Riots due to people not being able to make a decent living. UK is having severe problems. In fact, in UK, people have to decide whether they can use their money for heating or for buying food. They can't do both. And the United Kingdom is in severe economic distress, much more so than Europe. And that whole Brexit thing hasn't really helped Britain at all. So the Western world will see a lowering of living standards. As you may have noticed that a lot of people from Western countries, they come to India, particularly to places like Goa in the winters. One of the reasons they come here is that the cost of living in Goa is much less still compared to a place like the UK. The cost of energy bills is a lot less. The cost of food is a lot less. So there will be a decline in living standards in Europe and in the United States. And at the same time, as jobs have moved to Asia, you will continue to see a rise in living standards in Asia Pacific. And that's good for India, that's good for China, that's good for the rest of Asia. So that's a positive aspect from our perspective. And not so good from Europe's or America's perspective.
Right. Yeah. So going to the next question from Kanishka. So she has asked, like, what is your opinion on China trying to make yuan the international currency? Of course, you have touched upon this point already. You have mentioned that, like, maybe, like, again, not yuan, BRICS will be the currency that actually can replace dollar. But maybe any additional thoughts you want to share on that?
Sure. Yes, it will be BRICS rather than just yuan. But another interesting development that you will see is that I think 15 or 18 countries have now started opening, their banks have started opening rupee accounts in India to settle trade in rupees rather than through dollars. So another interesting thing that happened is that ever since America froze Russia's assets, the other countries are worried that tomorrow, if we have a problem with America, America can freeze our assets as well and prevent us from using the SWIFT system, which is an American system for worldwide transfer of funds. So there is a development of a new international payment system, which will not involve the US dollar. So trade will move away from dollars and into the currencies of the major trading nations. That includes China, Russia, India, Brazil, to some extent, and also South Africa. Another interesting development has been that Saudi Arabia, which was a very close ally of the United States, has now forged a partnership with Russia. In fact, Mohammed bin Salman, or MBS, was down in Moscow, and they are looking at trading energy in BRICS, not in US dollars anymore. There is a very interesting thing that I will share with you, that it was Henry Kissinger who had gone to Saudi Arabia in the 1970s and come to some agreement that the United States will buy oil from Saudi Arabia and provide military protection to Saudi Arabia. But all the payments for that oil will be in dollars. And that's what created the petrodollar. And it is the petrodollar which is the significant single most important factor for the rise of the United States as a world economic power and then as a world military power. There is a video on YouTube which says that if the petrodollar dies, so does America. So as the petrodollar becomes less significant, we will see a shift and a move towards a new world political and economic order. In fact, Sergei Lavrov, who is the foreign minister of Russia, he just recently said, I think it was yesterday or day before, that the strategic objective of the war in Ukraine is the creation of a new world order. So it's no longer about demilitarization or denazification of Ukraine. It is about creating a new world order. So that's a big statement from someone like the foreign minister of Russia. And with the partnership that you are seeing between Russia and China, which are actually neighbors and share a huge border, the new world order, which will include the political order and the economic order, is going to become a reality.
Yeah, absolutely. So a continuation question, actually, on this topic itself, so asked by Chetan, and he says that, like, how will this global changes impact us, and can we benefit from the new currencies like BRICS or TERL?
Yes, this is definitely going to help India. See, India is in a very, very unique, very interesting, and very good situation. Everybody wants India. The Russians have a very close friendship with India for historical reasons, starting with the Indo-Soviet peace treaty that was signed between Brezhnev and Mrs. Indira Gandhi, and the war of 1971. The Russians, the Soviet Union helped us enormously when the Americans and the British, were trying to really threaten us with nuclear armed and nuclear powered aircraft carriers and all sorts of naval equipment. We are in a unique position because we have a close friendship with Russia, and it's not going to go away. At the same time, America wants us desperately. They don't want Pakistan anymore, they want us as a bulwark against China. In fact, I think it was just yesterday, if I remember correctly, that a senior US official has made a statement. When Finland became part of NATO, they are offering NATO membership to India. And my wife is from Odessa in Ukraine. I just sent a message to my daughter, who's an American, that membership of NATO is a very dangerous thing. Because look, what the carrot of NATO membership has done to Ukraine is destroyed a very beautiful country with lovely people, great, agriculture, great science, great industry. Everything was wonderful. It's been destroyed by the lure of NATO membership. Now, if India is offered NATO membership and our political leaders decide that, yeah, we want to take NATO membership, we're going to end up with a war with China. And a full-fledged war with China is going to make India another Ukraine. We don't want that. I have many friends who have served in the army, and including officers who conducted the Kargil war. And one of the things that they say about India and China is that we will have localized conflicts between India and China, like Doklam and some other places where on the border there is a square off between an Indian mountain regiment and the Chinese. But we have an agreement with the Chinese that we will not use any weapons like rifles or bombs or artillery on the border on the LAC. So that's why people use lathis. The Indian soldiers beat up the Chinese with the lathis and throw them off. You may have seen videos of this on WhatsApp or on the internet. That is not a war, that's a skirmish. And that doesn't destroy the rest of the economy. If there's a skirmish in Doklam, that doesn't impact Bangalore, doesn't impact Delhi, doesn't impact Bombay in any way. So local skirmishes and misunderstandings on the border will continue because the border is not properly defined. So having a localized skirmish is okay, is not going to destroy India. But if we now say that we want to become part of NATO and take this bait that America is offering us, well, we are basically showing a red rag to the Chinese bull, and that will lead to a serious war, and we will become another Ukraine. We don't want that. We want peace with our neighbors because peace is a fundamental and necessary condition for economic prosperity. You cannot have prosperity if you are at war. You need peace. And for India, which is growing at 6, 7, 8%, is one of the fastest growing large economies in the world, the last thing we want is a war. So peace is our best friend, and that's how it should be.
Absolutely. Very, very well summarized, actually. Next question is from Umesh. Though we have dealt on a similar topic, but maybe just see if we can add anything to his question. So how this contagion spread will affect the Indian banking system, and is there any bank you are predicting that will go down if that happens?
See, the contagion within India is not going to be due to a Credit Suisse or a UBS or a Deutsche Bank. Their presence in India is not that huge compared to the Indian banking system. The contagion in India would be self-created, and one of the possibilities of contagion are institutions like State Bank of India, LIC, who have lent a huge amount of money to Adani Enterprises. So if there's a change in government, we go away from a BJP government to some kind of a coalition government, or there's a change in the political situation at the center in Delhi, and that could lead to a contagion within our country. And if State Bank of India goes into trouble, then there will have to be a taxpayer-funded bailout. That's not going to be good for the country. So our contagion would start within India. I think we are reasonably well insured from the contagions in Europe and the contagions in America there. The contagion in America is having an impact on India. As I mentioned, that the collapse of Silicon Valley Bank is having a direct impact on the startup ecosystem in India. Nitish and I were at the World Startup Convention in Noida just a few days ago, at the end of March. And one of the things that was missing was the presence of investors. And if there are few investors and a lot of startups, then obviously startups are starved for money. So the problems in America are already impacting our startup ecosystem, but they're not directly impacting our banking system. Our banking system is reasonably well secured. But the collapse of someone like Adani and a change in government in New Delhi at the center could spark off a fire, because everybody knows that Adani and the BJP government are two sides of the same coin.
Right. Absolutely. The next question is from Akshay, and he has asked, sir, if China is going so much of authoritarian, will the economic progress sustainable, or if BRICS currency will ever come?
See, China's authoritarian government is something within China. Let me share with you something very interesting, which was expressed by the former foreign minister of Singapore. He's an Indian gentleman, a gentleman of Indian origin, a Tamilian, Madhubani. And he's made a very interesting point that something like 100 million plus Chinese left China on tourist visas to travel around the world. And all of them came back to China voluntarily. Now, if China was such a horrible authoritarian place, why would this 100 million people come back? They could have stayed back in Europe or America and asked for political asylum. That didn't happen. So 100 million plus Chinese tourists left China, went overseas, and came back on their own. Now, I have some experience of China. I worked on a global bond issue for the Republic of China in 1994 with the Ministry of Finance when I was based in Hong Kong. What I have seen about China is that the Chinese work in a straight line. They go from this point to the next point without any turns and curves or anything. Absolutely is straightforward. We Indians and our Ministry of Finance and our government goes around in circles. It's too much bureaucracy. Unless the political party is paid some money in the form of bribes, decisions don't get made. That doesn't happen in China. So when people talk of authoritarian China, there is discipline in China. Well, you go to China and you try to spit on the sidewalk, or you throw some paper here and there, and you'll be in trouble. The same thing in Singapore. It's a disciplined society. In our country, you can throw anything wherever you want. It doesn't matter. So we have a lack of discipline. Now, is imposing discipline authoritarian? Yes, it is, but it's for the good of society. So there is, some benefit from having discipline in our institutions. I'll give you some specific examples. IIM Ahmedabad. The professor used to come with a quiz, every quiz paper every single day. And he would lock the door inside the classroom based upon the watch in the classroom. if the watch struck 9 o'clock and you had not come in, he would lock the door and you are outside. And the day he finds that not enough people many people are still missing, he would give the quiz. And those who were not in the class would get an F. Now that's authoritarian, but that's a form of discipline that was very specific to IIM Ahmedabad. Then we used to have certain assignments called written analysis and communication assignments. You were supposed to submit them on a certain date by 12 noon sharp. If you were 30 seconds late, you would get 1 subgrade less. Now that's authoritarian as well. But it actually made IIM Ahmedabad into the top management school in the country. And we were the top management school, not by a little bit. We were like much, much, much better than IIM Calcutta, which was the second best. And not just in studies, but also in sports and extracurricular activities. It used to happen every year in the inter-IIM meet. IIM Ahmedabad used to be the #1 in just about everything. So certain amount of discipline or authoritarian government is actually good for the society. So China is authoritarian without a doubt, but then the people are disciplined. They work hard, and that's led to that miracle that you see in China, the economic miracle. Japan was also a country like that, pretty authoritarian. I have worked for the Industrial Bank of Japan in London. You go to the head office in Tokyo, it's very different from the Industrial Bank of Japan in London. It's very strict, very rigid, very disciplined in the Tokyo office. The London office was just like Britain, very different. So simple answer is that, certain amount of discipline is necessary in our societies. It's good. The Western world doesn't like it. When I was a student at Columbia University, some of the students used to put their feet on the table during the class, and the professor couldn't say anything. Now, do you think that's a good thing? That's a free market. Do whatever you like. The student in a place like the United States is the customer. So he was given the free right. Do whatever you like. But that's not good for an education institution.
Yeah, absolutely. Not good at all. So now we are already like 15 minutes past time. So we'll very quickly take up the next few questions, and then before closing the session. So Frankie has asked, like, can you share next webinar details? Of course, Frankie, we will share once we announce. You will all receive intimations of webinar, and please keep track of our website, our social media handles as well, and you will also receive intimations over email and like maybe messages as well. Okay, so keep track of our website and social media pages also. You'll be updated about the webinar, and thanks for your interest. So next question is from Chitra. She asked, Deutsche Bank has come out a lot better situation than what it was around 4 years back. What are the similarities with Credit Suisse that can be concerning? Would you like to answer that question?
See, both Deutsche Bank and Credit Suisse were globally systemically important banks or SIBs. So Deutsche Bank has been able to get its act together much better than Credit Suisse. I can share a little bit of thoughts about Deutsche Bank because I never worked for Deutsche Bank, but I used to play cricket for the cricket team with Anshu Jain. So I have some insights, and I had some friends who worked at Deutsche Bank. Now, Deutsche Bank was a AAA bank. It was the absolute rock solid bank in Germany. But in the last 20 years, ever since they tried to become like an American investment bank, with a lot of people from Merrill Lynch who came in and from other US investment banks and got into the securities business, investment banking, trading, derivatives, it has suffered significant losses over a period of time, and the stock price has gone down and has become very volatile. But with the change in management at Deutsche Bank, they have managed to actually pull the bank back. However, Deutsche Bank is still very much in a similar business as Credit Suisse. And in fact, there was talk about Deutsche Bank being the next Credit Suisse. Whether that will come true or not, we don't know. But one thing we know for a fact is that the nature of the business of Deutsche Bank is still pretty volatile. all this securities trading business, derivatives trading business, investment banking business, fixed income securities, credit derivatives, etc. These businesses are inherently subject to a lot of volatility and to a lot of risk, whether it's market risk, credit risk, or even operational risk in many cases. So Deutsche Bank remains vulnerable, but it is in a much better position than Credit Suisse.
Right. So I hope that answers your question. Chitra, going to the next question from Sivan. He says that in case of exposure to funds like Archegos that blew up, how do banks like Goldman Sachs manage risk and get rid of their positions quickly? Anything you would like to add on that? Though you
Yes,
have
sure.
discussed.
Sure. See, Goldman Sachs is probably one of the fastest and most agile investment banks in the world. They hire the smartest people in the world. They also have the best technology of almost all the various banks that are around. And because of the entrepreneurial nature of the bank, its very smart people, access to some of the world's best technology, they are able to react to adverse market movements much faster than any other bank. And that is why they were able to get out of the problems at Archegos Capital while Credit Suisse was left holding the can. And this is very visible even when you interact with Goldman Sachs. You interact with a managing director at Goldman Sachs. He has the authority to take decisions. This was the same case in the case of Lehman Brothers. My managing director at Lehman Brothers, very brilliant man, PhD in economics from Princeton, he could make decisions without having to ask any committee about what we're going to do. So it was exceedingly fast-moving bank, very entrepreneurial. In simple language, in simple English, it's called being nimble, N-I-M-B-L-E, being very agile. So these American investment banks are traditionally very agile, they're able to make decisions and do things very fast. So they get out of any potentially adverse situations before that adverse situation becomes a tsunami, whereas the European banks are always lagging behind.
Right. Very, very insightful. Again, so the next question, Satyaprakash, I think this question we have already dwelt upon, so not repeating for the paucity of time. He has again asked about can the fall of banks happen in India? We saw PMC Bank, Yes Bank, but nothing like SBV. So we have dwelt upon that similar question. So not going into that question now. Like we're going to the next question from Asutosh, and Asutosh has asked: is 81 bonds are issued in India or not?
Yes, 80 additional tier 1 bonds were issued in India also. In the case of Yes Bank, there was a big issue in the case of the Yes Bank 81 bonds as well. You can just do a Google search, Yes Bank 81 bonds, and you'll get the entire history of what happened to their 81 bonds. So additional tier 1 bonds are issued by banks all over the world.
Right. Okay, so Aanchal has mentioned that she's joining as risk analyst in Citicorp India for the global portfolio in Citi. Can you advise, please? I don't know. I mean, yeah. So, would you quickly give her advice, or like, shall we go to the next question?
Yeah, sure.
It's a very specific.
No, Citibank. See, look, Citibank is a very well-known bank. So, I can assure you one thing, that even if something happened to Citibank and you lost, and there was an adverse impact on your job, having Citibank on your resume will always help you. So I don't see any major downfall or drawback in joining Citibank as a risk analyst. I would think it's a good opportunity. I would urge you to learn as much as you can at Citigroup. It's always a great place to learn. And should Citibank go under, I can guarantee that you will have plenty of other banks ready to hire you very quickly.
Yes, absolutely. So Aanchal, no worries on that. I also think it's a very good opportunity. So please do go ahead, join that, and all the best for that, your new assignments. Right. So next question is from Otaru. Otaru has asked, so to what extent is SVB, etc., bank collapse due to Fed's job, given the tension between supply versus demand inflation? So, I mean, you have explained this during your talk, but anything you would like to add to him?
Well, the Fed, as I said, is between a rock and a hard place, or between the devil and the deep sea. If they don't raise interest rates, you're going to have inflation. So to combat inflation, they have to raise interest rates. But if they raise interest rates, you will have adverse impacts on the bond markets. And since many, U.S. banks are holding bonds, they're going to see losses, unrealized losses. And if they're forced to sell their holding of bonds, then those unrealized losses become actual losses, and then they need to raise additional equity. So, the Fed chairman has a pretty difficult job to do.
Absolutely right. Next question is from Shoham, and he has asked, do you think that regulation in India needs to loosen in order to reach $5 trillion economy? I think yes. What is your opinion?
See, regulations are like policemen. You need policemen to control, adverse people or bad people in the society. Similarly, you need regulations to control bad bankers who may be indulging in all sorts of activity that could be disastrous in the future. If you want to reach this whole $5 trillion economy, it's just become a political stunt, actually. If those of you who have studied economics in college or in university, and if you have studied national income accounting, or if you have had a chance to read a book by Paul Studensky, on the very first page, in the very first chapter, on the right-hand corner of the book, National Income Accounting by Paul Studensky, it talks about the unpaid services of the housewife. So all the 3 hot meals that your mother and my mother used to cook for us when we were children, and all the work that millions and millions of women do in their homes, that's not counted in the national income. That's not counted in the GDP. So I actually am of the view that India is already a $5 trillion economy. When you wash your clothes at home, instead of giving it to the laundry, that effort of washing your clothes is not counted in the GDP. Similarly, if you cook food at home, instead of going to the restaurant, that cooking doesn't have any monetary value. It's not counted in the GDP. But if you went and ate the same food in a restaurant and paid money for it, it would be counted in the GDP. Now, there are millions, I would say hundreds of millions of households in India where food is cooked at home, clothes are washed at home, cars are washed at home, a lot of things are done at home. That's not counted as part of GDP. So in reality, the fact is that I personally believe that we are already a $5 trillion economy. We just don't count it. But as we become more like America, where instead of washing clothes at home, you give it to the laundry, you have breakfast, lunch, and dinner from McDonald's or from Taco Bell or KFC or Domino's Pizza or whatever, a Pizza Hut. Everybody starts to eat out. That's why the US economy is like such a huge economy, because a lot of its economic activity is monetized. A lot of economic activity in India is not monetized. So I don't really think we need to loosen regulation just to become a $5 trillion economy. My personal view is we are already there. We just don't count it. Next time, if your wife cooks food for you or your mother cooks food for you, you pay her with a credit card. And if everybody starts doing this in the country, you'll be $5 trillion economy by the end of this year.
But that's a very interesting spin to the topic. Right. So maybe the last question for the day would be like again from Praveen. So it's a follow-up question. Though you have already answered this, maybe like if you want to add something before we close. So he has, how is India placed on the times of US and Europe recessions ahead? You already mentioned that India is in a sweet spot. Any more words on that, and then we will end the session on that note.
You see, I think India is in a pretty good situation. I strongly believe that India's best days are ahead of us. The only India is going to do very well, but the problems that we are seeing in India. In fact, there's a very interesting book called The Indian Metropolis. It's a big, thick book written by Varun Gandhi. What is happening is that as India is getting urbanized, people are moving from rural areas to urban areas in search of more money or better paying jobs. The urban areas are just expanding, 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 and our environment is being destroyed. Our cities are becoming unlivable. Delhi and Bombay, even Bangalore to an extent, are classic examples where traffic moves slowly, pollution is rampant. So India is in a very good spot from an economic standpoint. We will continue to do very well. But is this economic expansion really beneficial for India as a society? That's a different question altogether.
Yeah, again, a very different take, and it's like wonderfully insightful. Can we take one more question? I mean, very quickly.
Okay.
This is from Kanishka. He has just added the question. So, sir, what is the situation of RBI in dealing with uncertain financial world? Anything want to add on that?
See, I think that RBI has been doing pretty well in terms of trying to insulate India from the volatility of the global economy. But the truth and the reality are that now India is a part of the global economy. So there will be, from time to time, negative or volatile impact on India's economy because of something that happened in America or something that happened in Europe. For example, the whole oil market was severely impacted by events in Europe. But the impact was felt dramatically in India because of higher fuel prices. Now, there's not much the RBI can do about that. What the RBI can do is to make sure that they are on top of our monetary policies. They take adequate steps ahead of time to prevent rampant inflation or a debasement of our currency. So price stability and currency stability are very important factors for the growth and development of a country's economy. And I think the RBI is doing a pretty reasonably good job. I'm not a monetary economist, so I'm not in a position to go into any great detail about what they should do. But the people at the RBI know best, and they know what to do to help keep the Indian economy on an even keel to ensure both price stability and currency stability.
Yeah, absolutely. I have a request. So there is one question which Sanjay has actually mentioned, and maybe I have missed out. So he has requested us to actually dwell on that. So that would be the last question.
Sure.
And so I would request the participants not to put any more questions. I mean, you can, if you have any more questions, we are already half an hour exceeded our time, right? So please, you can send the question personally, and again, we would try to answer them one-on-one. But this will be the last question for the day. Sanjay said that last centuries we have seen many financial crises in the world, and it is in sequence like every 10 to 15 years. Therefore, could we say every decade will be the global financial crisis?
Yes, that has been the case of the global capitalist system right from the beginning of history. There's a wonderful book on understanding European American financial systems. That book is called The Ascent of Money, written by Neil Ferguson. He's a professor of economic history at Harvard. Very, very good book. It explains the workings of the bond markets. It explains the tulip mania in Europe. It also talks about the problems that were there in the Mississippi Valley and in New Orleans, and how the Mississippi bubble burst, and how bubbles were created in Europe even when there was no digital currencies and no internet. I strongly urge all of you to read the book. There are videos available about that book on the internet. We can maybe have a webinar sometime to discuss that in more detail. We
Sure.
can call the webinar the booms and busts in world capitalism.
Absolutely. All right. So with that, actually, we come to the close of the session. And first of all, I would really like to thank Mr. Bhatia for the wonderfully insightful session. And these were insights which can only come from your, profound experience in the field and first-hand experiences. So thank you so much for sharing all your insights and thoughts. And I'm sure all the participants found this session to be extremely useful. And I also thank all the participants for their patience. We have exceeded our time, but it was such an engrossing discussion that we wanted to keep the discussion flowing, and we always want to answer as many questions and queries as we can. So with that thought actually, with thanking you all for joining us, and thanking you once again, Mr. Bhatia, for sharing your thoughts, spending your time with us on this talk and giving your talk. And for all of you, please keep following us for our next series of webinars. As you all know, as a part of this webinar series, Deep Thoughts with IIQ of Experts, we conduct our webinars regularly on various important topics related to finance and our field of advanced financial analytics, right? Financial engineering, risk management, and algorithmic trading, etc. So keep following us in our all our social media pages, our website, and of course, we will be updating you over emails on our next webinars. So keep following us. Have a wonderful weekend. And with that, we come to the end of the session. Thank you.